Good evening, everybody. This is Chrisi from Solstice ATR and Vulcan Capital's Research. To subscribe to our website, more than happy to help you guys. First of all, before I do, that's Solstice. My handle on Twitter is Chrisi Farah, and on Discord, it's at ZOUZOU9345. Basically, this is an educational. All illustrations on the charts are for education use only. Okay. Let's first start by taking a look at the S&P, the Nasdaq, the Russell, and the Dow. We are still intact in an uptrend. We have not lost this weekly candle here when we fell down. We looked into it halfway, then we eventually fell back down on the combination of those four instruments. We are still intact above the 61.8 fib. As long as we are holding that area, we are intact. Let's look at it on a daily chart, how it looks like a little bit more. And on the channel is still intact. We still have the 50 simple moving average. We do still have this gap here. We have this gap here and this gap here. In order to lose it, we have to lose 37,100 and let's call it 18 in order to continue lower, and that's your 50 SMA, and that would be the 38.2. Is it possible due to the fact that there was a spike in the virus, coronavirus, or known as COVID-19 in California, Georgia, Arizona, and in Texas? Is it going to cause a second shutdown in the domestic markets? Possibly not. In international markets, they have recovered, most of them, going back to their lives and starting work. So we have to be open-minded, flexible, fluid, not biased to being bearish or bullish. We're going to trade what we see, and that's the best way to evaluate the charts that you see in front of you. You can make them as simple as possible. You can make them as hard as my charts that I have up there due to the Java encryption that's built in. As overall, if you can notice on the S&P 500, the Russell, and the Dow, we are still intact above the 50 SMA. We have not taken out that level here in order to continue lower. So let's first of all, I would like to do by taking a look. I don't talk about the small cap, which is the RUT, but I want to talk about its indice for basically the volatility of it. It's RVX. This is Russell 2000 Volatility Index, which is the ETF is IWM, or the RUT, it depends where you're trading at, or /TF or /RTY. That's the E-mini contracts for the small cap Russell. If you notice, we're still below the 47. It's been a little bit weaker than most instruments. This is the VIX. We have recovered since, the February, 20 is still March 23rd. We've recovered quite a bit of grounds. We created, this is the shoulder. This is the head of it. Does it form a shoulder to continue higher? If there's something going on globally and the outlook in the next 4 to 5 years is really, really bad, when we're not recovering, we have, a depression, then we'll break up and continue higher in the VIX and the market will fall. But if we cannot take out the 47 area, 48, I think we're still going to be the outcome in the next 5 to 6 months, getting better and better, and we can continue higher in the market. But there will be on short-term time frame a little bit more volatility before we can get out of this area. So that's the VIX on the Russell. A second thing I'm going to look at is the VIWIGX, which is the index, or the V. They are similar. And if you notice, we have not taken that area here when we fell down, and we haven't taken the bottom head of this shoulder. You can see that's the shoulder, went higher, that's the head of it, came back, created this shoulder. We're still in balance until we take that 43 area out. And if you take a look at the /VX and the and if I look at the VIWIGX, which is the ETF one, it's in a similar situation as well. I do have channels and fibs on these zones because I use the /VIWIGX myself for trading. And if you notice, it's creating around it since that last spike of the week before. The VIX hasn't moved that much. In the overall market, the weekly VIX is basically down 6.8% in the last week or so. So don't be biased and trade what we see. And let's take a look at one more before I go into the instruments I usually do. I'm going to look at a global fund, which is the Vanguard fund. It's a global VIWIGX, I believe. If you look at it on the daily, it looks at the high. Remember, it mimics the indexes in the global markets and international markets worldwide. If I look at it on the weekly chart, we have reclaimed the prior highs, and we are higher. This is the tariff in international markets. We recovered, we consolidated for a little bit, went up, double top, let's consider that. We fell back down, and we have recovered this area. As long as we're above the 33, we're still bullish. So that's why I put that up there, because some of the global markets are reopening, going back to work. Let's take a look at the SPX. I'll start with SPX first. This is the weekly. We're going to go to the daily chart. And we'll go 9 month. Where is it? 1 year. Okay, we'll do the 1 year. 1 year, if you notice, I should have taken this channel up, but that's fine. I have it there, and I have this one here. If I put one from here to here, it'll show you that we are in a linear regression channel. And you should be able to use channels to keep you intact when you're trading to the upside and downside. We'll remove the other one because I had one wider from here earlier, and we have lost that one. There's these two gaps. There's another one here. We created an edge, and came back down. The 31.55, 31.56, 60 area is going to be very important area for us to consider when we're coming back up. When we retest these 4 highs, we're going to fill this gap and continue higher. We do have the 50 simple moving averages right under us. We do have the 29.60, and at the same time, we do have the 28.55 area from the H pattern that we lost last time when the market fell in February till March 23rd. I'll show you that again one more time. You can see that H pattern. This is an area that we have to always keep an eye on. If we fall back down, does this consider to be support in the 38.2 to continue higher, or do we reverse clear those 3 tops to continue back to the upside of this channel and fill this gap on the other side? So that's the SPX. Let's take a look at the NDX. It has a little different. The NDX, this was the annual high. I never changed the fib on it. We've created an H. We fell down, and the technology sector and the biotech sector, the top NASDAQ 100, have eventually cleared the 61.8 from here to here. We cleared it, and we continued higher inside this linear regression channel. There's a bottom one here. There's a higher one here. Every time we came back to the bottom, we bounced off it, came to the bottom, bounced off it, came to the bottom, bounced off it, bounced off it. This time is going to act as support, and we do have the 50 simple moving average. Remember, don't be biased to one side, because sometimes things don't work out. And if this eventually gets a grip on that channel, does it bounce back up and continue, or does it fall, get to the 50 simple moving average? That's the NDX. Let's take a look at the Dow Jones Industrial at the $DJI. Oops, $DJI. Okay, there we go. Oops, computer's giving me a little. Okay, if you notice on the daily chart in a similar situation, we still have not lost this area. We are on the 50 simple moving average. I did this channel earlier, on Friday. I was looking at it, and the 50, the SMA did hold us. We are below the 50 fib. We're below the 38. This is the 100, and that's our minor support. We do have this gap here in order to fill. And if in order to fall back down, you got to look at Boeing, Apple, and other instruments at the same time, the components of those 30 companies in relationship to what the Dow does in order to stay intact, or do we fall? Or do we reverse here and go back up? Halfway, you can do an imaginary line between these two, and these are called linear regression channel, and that would be the midpoint right in this area to the top. If it acts as resistance and we cannot clear this area, then we fall down or we fall through this channel, look for the backside of this gap and this area here. So let's take a look at the small cap, RUT. I put the VIX up earlier for everyone to take a look at. And this is the reason why I put it. If you notice from the March 23rd, and this is the February 20th, 22nd, when we started falling back down, this was the H pattern. We looked into it. We tested that area. We came back, fell in. We are still holding the 50 simple moving average. The 18 is right above us. In order for the Russell to stay intact, we have to hold the 50 and the 38% in order to continue back up. And we do have this gap in this area here. I do not have it marked. We do have another one down here and one more down here. So keep an eye on the Russell to give us clues, because the small cap usually is the leader and it's in the canary in the coal mine. So that's that. Let's take a look at now the E-mini contract that I usually use and I trade in my group. It's about the overall market. So here's my mouse. Okay, here we go. And if you notice in it, we have a linear regression channel. We're still holding. We are still intact. We did not lose the 50 SMA. We did hold this minor channel. And we are in a downtrend. And what I'd like to do is go on a 4-hour to show you, and this is the H pattern that we're going to fall in. That's the 53 quarter. On the SPX, it's 55 in the decimal place. So as long as we are intact, and this is a lot of consolidation here, this is the gaps. I usually put them on because I show the overnight action in there. There won't be much gaps sometimes to look at, and here you don't see the gap because this is in the overnight action. When we fell, we got to keep an eye on this candle here, and this candle in order to come back and clear and continue higher. And these are around the 55 to 56 area. You can see in that in order to continue higher, we just need to pour highs to fill the gap to continue higher. And if we fall through the 50, look for the consolidation in this area in order to keep us intact. And remember, 29, 60 area is going to be a very valuable area to give us clues if we're going to stay down or go back up. Let's go to the 4-hour, show you how it looks like. What I did on Discord, it showed us basically that the advanced decline line, when it hit a low, and my RSI, I don't talk about technicals as much, it was bottoming out here. We did an H pattern, we came back in, bounced off this channel. We are in a symmetrical triangle. You can see there's a channel here and a gap, channel here and the bottom. And these are the overnight, the gray areas are the overnight. I put them in to see what the actions in the European and Asian markets are, to give us an idea if we are in an uptrend, downtrend in relationship to the prior day's close. So, I mean, I just reference them, and this is why I said, hey, we're going to keep an eye on this area in order for those 4 highs, in order to continue back up and go higher. This was an advanced decline line that we retested. It was 29.92 and a quarter, and the low on this one was 29.92.50. We basically missed it by 1 tick, reversed and came back inside this channel, and you can see we have a cone, we have a down channel, and I have a symmetrical triangle. We don't know what the outcome will be Monday. Do we gap down and come back up, or do we gap up and continue, or go side action? So trade what we see until we get out of this symmetrical triangle and the cone. Now let's take a look at some other instruments. I want to do a couple before we go, and I want to talk about the volume profile. I'm going back to daily. I'm going to go through them very fast. AAPL. And the reason why I'm put up, I want you you guys to see that some of the large cap have, came back a little bit on the daily charts, and this is why I'm having up there. That's Apple, Amazon, similar thing, Baba, Facebook. If you notice, this was the consolidation. Eventually broke through the 10. This was a nice call short into the group. In the consolidation, we fell through. We hit the 50 SMA. We filled the gap. In order for it to consolidate and hold, it has to hold this area and this area. If it doesn't, then look for the 38.2 for a rebound in the 200 SMA. Let's take a look at Google. And Google had fell through the channel. And if I do a channel from here to here, it's no longer intact. You can see it. If I do it, it's no longer intact. So what we want to do is grab this channel here. You can see this gap here. And what I want to do is connect it to this channel here. Connect it to the low. And you'll have a linear channel going across from here to here, showing you these are symmetrical in the overall range in the cone. If we fall through that 116 to the 238, we'll fill this gap in order to continue back higher. So that's Google. Let's take a look at Netflix and NFLX. And Netflix did the same thing on Friday, fell down sharply. If you notice, I had this channel here. I can just go back and draw another one in from here to here to here. You can see it, the computer grabbed it. We do have the 18 and 50 for support. If it falls through it, look for the channel consolidation in this area to continue higher, or it reverses, goes back in. That's another way to look at it. And here's Tesla. Oops. And Tesla, it looked up a couple of times in the 950, 980, the 1020. It had a recovery on Thursday. Friday fell back in. We're holding the 18 SMA. We do have these two gaps here and the third one here. This is a major consolidation in this area. Usually either the 50 or the 38.2 will hold it well. If Tesla comes back in this range, I would look for, a buy zone between the 775, 800 area. Let's take a look at Twin Resort, just to go over some of the stuff that way. Oops. Twin, see, it fell back down. Let's take a look at Boeing. Boeing fell back in. Let's take a look at Goldman Sachs. Similar situation. BLK, intact. Shopify, SHOP. Shopify is up. PayPal, PYPL, Roku, but Roku is going sideways inside this channel. I kept these from prior. We fell back in. This is the shoulder. This is the head of it. If this is going to create a shoulder and go back up, it's in a triangle. As long as in this symmetrical triangle, look for the back side here or the upside of this one to continue higher. You're right on the 50 and the 18 SMA. And let's do the ES, back to ES. Before I do go tell you what the outcome is, and I'm going to grab it. Where is it? There it is. Remember, I did this a couple of weeks ago in the group. I talked about charts are a reflection of human behavior. That is true. Humans act on action and reaction and fear and greed. Humans act in similar way during periods of high stress and high fear. Humans act in similar way when they are fearful or being left behind. Humans act in similar way during bottoming process. Humans act in similar way at an early stage of a new bull market because the outcome and the news in the media gives them fear in their eyes, and instead of participating, they don't participate. They're looking for a hope or a way to understand what's going on. Let's just go to the next one. I put gold versus the S&P 500 since 1982. There was a spike in gold in 1982 when there was fear. In 1988, the real estate bubble in 2009, 2013, 2016 in the Eurozone wasn't as bad. And we had the 2020. we only have 4 time conditions. One, we hit a spike. We had a 2. We had a 3. We had almost a 4. And we had a 4-time spike when the situation was very bad. And if you notice, this condition is reversed from the 1982 spike in gold. Let's take a look at the second chart. S&P performance followed rare performance flip to gold ratio from 1982 till 2020. I put the 1982 weekly, 1 month, 6 month outlook. 5 years outlook was 82%. If I look from 1988, 67% outlook for the market in the next 5 years. If I take a look at 2009, 106%. Remember, these are historical facts. I'll zoom in just to show you. For education use only, okay? 2013, similar situation, 69%. The average across the board is about 75. Does the market come back and continue higher? Of course. Here's the S&P relative to the emerging market. And what I did here, I did a similar situation using the emerging index market in the first week, second month, 6 weeks, 3 months, and the worst scenario in 1999, we had a -5, we had a 21%, we had in 4 years 30% and 16%. Remember, this is the emerging index account that I showed you guys earlier. It has recovered. It does not look like 1999. 2003, the reversal was 64%. 2009 was 105. From 2016, 4 years outcome is 42. We do not have 2020 in our hands yet. If we take a look at the first month, second month, and the worst scenario, the pitfall is -25%. And the maximum gain in 1 month to 5-year average is 64%. Another one here is the S&P followed by a very sharp rally after a major low. If we take a look from February till March, we had a major down. And from March 23rd, we continued higher. So if we take all these averages in, and we assume that in 6 months, the worst scenario from 1932 was 13%, in 82 was 16, and 2009 was 17, we take an average that's 16% return, and the overall outlook for the next 5 years is 107% compounding rate. And one other one, what was really bad, Economy in Wall Street Journal, that's bipolar, you can go look it up, and David Harrison, have told us that people are going back to their manufacturing and rebuilding stuff, and everybody's coming back online. Last but not least, this is the evaluation that Friday caused a reaction in the market. Data set in front of us. Does that mean Arizona, California, Florida, Georgia, and Texas gonna cause a big spike in COVID-19 and recovery? If you notice, New York spiked up like Italy and starting to fall down in the COVID-19 recoveries. So we have to take it day by day, listen to what the market gives us, be flexible, not biased, trade what we see, not what we think, and I hope this was helpful. Last but not least, we're going to go here on the style. We're going to go to the monkey bars like I usually do. We're going to evaluate it. And how many days we have here? 10 days. Okay, let's zoom down. Okay, we're going to count 5. 1, 2, 3, 4, 5. So this was our peak. This is our bottom. So what was the bottom here? Let's write it down. 29.92 half, and the top is 31.45, 31.45.75. I did not use the 31.56 and a quarter I just want to use these 5 days. I know the POC is a little lower. If you notice, the POCs from the prior week were always in the same consolidation. So we're going to take a fib. And taking that fib will help us evaluate where the market can head to. The high was 31.45.75. Back up, close enough. And the bottom was 92.50. Okay, we're going to adjust that fib, edit it, so we can fix the top and bottom. Edit properties. We're going to make this 75. We're going to make this one down the bottom 50. Push OK. And if you noticed, our time of sale on Friday and most time was spent was up here. And we closed up below the POC. If I consider that there is value in this area, we have to clear the 23, the 28, the 60, the 80, and eventually coming back to the 24, 45 to continue higher. What I'm going to do is zoom down. I'm going to show you the fibs first, so that way we can evaluate them. And in order to continue higher, we got to fix the top, and we got to clear the 45, clear the 56 to get to the 31.80. If we're going to fall down, we're going to look at the 29.56. We're going to look at the 29.33 and 29.29. But last but not least, we'll look at the 50%, 29.15 and 29.87. If you noticed here, I do not have the 138 and I do not have the 50 up here. So if I'm going to have the 38 here and the 50, I know my lines are, this is my 50, should be about here, should be about 32,100. And if I want to look at the 38.2, it should be about 3,200. So overall, we're going to trade what we see, not what we think. We're going to evaluate what we have in the market to give us an idea where we can head to. And I hope this was helpful and you understand why I did this fib. You can get an idea where the levels are. I look forward to seeing you on Discord, and you can check us out on Solstice ATR. Hope you had a wonderful weekend. Enjoy the video.